Right now, millions of Americans over the age of 65 are writing checks for 5 specific bills that they are legally exempt from paying. And the IRS is absolutely not going to tap you on the shoulder to tell you about it. If you have crossed that milestone birthday, every month you continue to pay these hidden charges is a month you are handing over your hard-earned retirement savings to institutions that already know you do not owe them a dime. But there is one specific charge on this list, the very last one we are going to cover today, that is draining thousands of dollars from retirees' bank accounts right under their noses, and fixing it takes less than 10 minutes. This is not about complex legal loopholes or shady accounting tricks. This is about your rights as a retiree. You spent 40 or 50 years working, paying your dues and funding the system. And the system actually has built-in relief valves designed specifically to protect your income once you turn 65. The problem is that these exemptions are strictly opt-in. They are buried in the fine print of your tax code, your utility statements, and your municipal laws. As someone who spends every single day looking at the fine print of retirement finance, I can tell you that the default setting of our financial system is to take your money until you explicitly tell it to stop. Over the next few minutes, we are going to walk through exactly what these 5 bills are, why you are likely still paying them, and exactly how you can stop the bleeding today. I am going to start with a massive expense that affects nearly every homeowner, but you must stick around for the final point because it involves a federal tax overpayment that traps almost everyone who transitions to a fixed income, and it is the single biggest drain on new retirees today. Let us begin with the heavy hitter that causes more sleepless nights for older Americans than almost anything else. You work your entire life to pay off your mortgage. You celebrate that final payment, thinking you finally own your home free and clear. But then, the envelope arrives from the county assessor, and you realize you are still effectively paying rent to the government just to stay in your own house. I am talking about property taxes. What most people do not realize is that the moment you turn 65, you likely cross a threshold that fundamentally changes your relationship with your local tax authority. Across the vast majority of the country, local governments have specific legislative mandates designed to prevent seniors from being priced out of their homes due to rising property values. Yet, millions of seniors continue paying the standard, skyrocketing rate year after year. The reason this happens is that your local government does not automatically flip a switch on your 65th birthday. They do not send you a congratulatory card with a discount applied. You have to demand it. There are generally 2 mechanisms at play here that you are missing out on. The first is a senior property tax exemption, which directly reduces the assessed value of your home before the tax rate is even applied. The second, and perhaps even more powerful, is a property tax freeze. A freeze locks in the assessed value of your home at the time you apply. Imagine if you had locked in your property taxes a decade ago. Think about how much money you would have saved. Have you ever considered how much of your monthly budget is currently being eaten alive by local taxes just because your neighborhood became more popular? If you are living on a fixed income, an unexpected spike in property taxes can force you to choose between keeping your home and buying groceries. It is a terrifying reality, but it is one you might not actually have to face. To stop overpaying this bill, you need to contact your county tax assessor's office immediately. Do not wait for tax season. Do not wait for your next bill. Call them and specifically ask for the application for the senior citizen tax exemption and the senior valuation limitation, or freeze. You will need to provide proof of your age and, in many cases, your income. The income limits for these programs are often much higher than you might think, sometimes excluding Social Security from the calculation entirely. By failing to fill out this one piece of paper, you are essentially volunteering to fund local projects out of your retirement account. It is time to stop being a volunteer and start claiming the protection you have earned. Now, let us move to the second major bill you need to stop paying. And this one involves a massive misunderstanding about how your Social Security benefits are treated by the government. When you were working, you were trained to believe that all income is taxable. You earned $1 and the state took their cut. But retirement income is fundamentally different, and the failure to recognize this difference is costing retirees a fortune every single April. I am talking about state income taxes on your Social Security benefits. Many people use automated tax software or go to a quick turnaround tax preparer who simply rolls over your profile from the previous year. You get your 1099 form from the Social Security Administration, you plug the numbers in, and you pay what the screen tells you to pay. But did you know that 38 states do not tax Social Security benefits at all? And of the states that still do, almost all of them have massive, sweeping exemptions based on your age and your adjusted gross income. The tragedy here is that the tax software does not always catch this if you do not explicitly categorize the income correctly or claim the specific age-based exemption on your state return. You could be writing a check to your state government for hundreds or even thousands of dollars that they have no legal right to collect. Think about the sheer frustration of paying a tax on money that was already taxed when you put it into the system years ago. You are being double taxed out of sheer administrative oversight. If you live in a state like Colorado, New Mexico, or Utah, the rules regarding how much of your retirement income is shielded from the state government change constantly, almost always in favor of the retiree. But the Department of Revenue is not going to audit you to give you your money back if you overpay. They will simply cash your check and thank you for your generous, albeit unintentional, donation. To fix this, you must pull out your last state tax return. Look specifically at the line item for state taxable income. If your Social Security benefits are included in that number, you need to immediately check your state's specific threshold for senior exemptions. If you have been overpaying, you can file an amended return for the past 3 years. You can literally reach back into the past and pull that money back into your bank account where it belongs. Do not let old habits from your working years dictate how you manage your money in retirement. This brings us to our third hidden bill. And this one feels like a betrayal to anyone who has carefully planned their retirement. It involves your health care, specifically Medicare. When you turn 65 and enroll in Medicare Part B, which covers your doctor visits, and Part D, which covers your prescriptions, you are told there is a standard monthly premium. But many new retirees open their first Medicare statement and are absolutely shocked to see they are being charged double, sometimes triple the standard rate. The government simply deducts this massive amount directly from your Social Security check before you even see the money. This surcharge is called the Income-Related Monthly Adjustment Amount, or IRMAA. Here is why this is a massive mistake that you are likely paying for right now. The government calculates your Medicare premiums based on your tax return from 2 years ago. Let that sink in. If you retire at age 65, Medicare is looking at the income you made when you were 63. When you were 63, you were likely at your peak earning years. You were working full-time, bringing in a salary, maybe you sold a house to downsize, or maybe you cashed out some stock options to prepare for retirement. The government sees that artificially high income from 2 years ago and automatically slaps you with a massive penalty on your healthcare premiums today. They are charging you based on a financial life you no longer live. You are living on a fixed income right now, but you are paying healthcare premiums meant for a wealthy executive. It is infuriating, but more importantly, it is entirely reversible. The Social Security Administration has a specific form called the SSA 44. This form is your golden ticket. It is the life-changing event form. Retirement is explicitly recognized by the government as a life-changing event. By filing this form, you are legally instructing the government to ignore your tax return from 2 years ago and instead calculate your Medicare premiums based on what you are actually making right now. I have seen retirees claw back thousands of dollars a year just by filling out this one single document. Do not accept a reduction in your Social Security check just because a computer algorithm is looking at the ghost of your past income. You must appeal this surcharge immediately if your income has dropped since you stopped working full-time. We are about to move to the fourth bill, but before we do, I want you to mentally tally up what we have discussed so far. We are talking about hundreds of dollars a month in property taxes, state income taxes, and Medicare premiums. But the bill we are about to discuss right now is stealthy. It takes $20, $30, or $40 from you every single month, silently bleeding your accounts dry over the course of your retirement. And right after this, we are going to expose the ultimate IRS trap that catches almost everyone. so stay with me. The fourth bill you need to stop paying in full is the hidden mountain of surcharges, municipal taxes, and regulatory fees attached to your telecommunications and utility bills. Have you ever actually looked at the second page of your phone bill, your internet bill, or your gas and electric statement? It looks like alphabet soup. There are universal service fund fees, state municipal franchise fees, gross receipts surcharges, and a dozen other line items that make up a massive percentage of your total bill. What the utility companies desperately hope you never figure out is that across thousands of jurisdictions, seniors over the age of 65 are legally exempt from many of these local municipal utility taxes. Furthermore, the federal government mandates that telecommunication companies participate in programs like Lifeline, which provides massive discounts to seniors living on a fixed income. But even if you do not qualify for low-income assistance, your local city or county likely has an ordinance on the books that waives the municipal tax portion of your utility bills the moment you reach retirement age. Why do you still pay it? Because the utility company has no idea how old you are, and frankly, they do not care. It is not their job to reduce your bill. It is their job to collect the revenue and pass the tax on to the city. Think about the winter months when your heating bill goes through the roof. A 10 or 15% municipal tax on a $400 heating bill is real money. It is money that should be going toward your groceries, your grandchildren, or your savings. You are subsidizing the local government through your thermostat. Tomorrow morning, I want you to gather your phone bill, your internet bill, your water bill, and your energy bill. Call the customer service number on every single one of them. Tell the representative that you are over 65 and ask them to apply the senior citizen municipal tax exemption to your account. Then, ask them to evaluate your account for any senior-specific base rate discounts. Do not let them brush you off. In many areas, this is not a corporate courtesy. It is a legal requirement that they remove these taxes once you identify your age and request the exemption. Stop letting utility companies act as an invisible tax collector in your home. Now we have arrived at the final, most critical point in this discussion. This is the ultimate trap. This is the bill that causes retirees to essentially give the federal government an interest-free loan with their own survival money, all because of a deeply ingrained fear of the IRS. If you have recently retired and you have any kind of passive income, like a small pension, withdrawals from an IRA, or dividends from investments, you must listen to this carefully. When you were working as an independent contractor, or if you had side income, you were drilled with the idea that you must pay quarterly estimated taxes. If you don't send the IRS a check 4 times a year, they will hit you with penalties and interest. So millions of Americans carry this fear into retirement. They do the math, they look at their IRA withdrawals or their small pension, they assume they owe a massive tax bill, and they faithfully write a check to the IRS every quarter. They are terrified of getting a letter in the mail. But what they do not realize is that the moment they turn 65, the mathematical formula the IRS uses to determine if you even owe taxes completely transformed. First, the moment you turn 65, the IRS grants you a larger standard deduction. It is an automatic bump in the amount of money you can earn entirely tax-free. Second, a massive portion of your Social Security is likely completely shielded from federal taxation, depending on your combined income. And third, there is a specific, highly underutilized credit called the credit for the elderly or the disabled. When you combine the higher standard deduction, the shielded Social Security income, and this specific credit, millions of retirees cross a threshold where their actual federal income tax liability drops to absolute zero. Yet, out of fear and habit, they keep writing those quarterly estimated tax checks. They are paying a bill that does not exist. The IRS will never stop you from overpaying. If you send them a check for $2,000 every quarter, they will happily cash it. And yes, when you file your taxes the following April, you will get a refund. But do you realize what you have done? You have taken your precious, finite retirement capital, money that should be sitting in a high-yield savings account earning you interest, or money that you need to buffer against inflation at the grocery store, and you have given it to the federal government to hold on to for a year for free. You are financing the government while you are struggling to manage a fixed income. You must sit down with a tax professional or use an updated tax calculator to determine your actual real-time tax liability for this specific year. Stop operating on the assumptions of your working years. If your new deductions and credits wipe out your tax liability, you need to stop sending those quarterly checks immediately. You must protect your cash flow. Cash flow in retirement is oxygen. Every dollar you needlessly send away is a dollar you cannot use to protect yourself against the rising cost of living. The IRS knows exactly what your exemptions are, but they are waiting for you to do the math. We have covered a massive amount of ground today, and I want to make sure you walk away with a clear understanding of your rights. You have the right to challenge your local government and freeze the property taxes that are threatening your ability to stay in your home. You have the right to shield your Social Security benefits from state governments that rely on outdated software algorithms to tax money they have no claim to. You have the right to appeal to Medicare and demand they stop overcharging you for health care based on a salary you no longer make. You have the right to strip the municipal taxes and hidden surcharges off your utility and phone bills. And finally, you have the absolute right to keep your cash in your own bank account, rather than sending it to the IRS in quarterly estimated taxes that you no longer owe. These are not handouts. These are mathematical adjustments that reflect the reality of living on a fixed income after decades of contributing to the economy. But the system requires you to take action. The system requires you to make the phone call, fill out the form, and demand your exemptions. I want to hear from you down below. Have you successfully appealed your Medicare premiums, or have you discovered you were paying property taxes you were exempt from? Comment your experience right now, because your story might be the exact push someone else needs to finally take action and protect their own retirement.